Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 120th VideoCast and 110th podcast for the week ending February 3rd, 2022. A lot to cover. We're going to try to keep it a little shorter than last week. We ran over last week, but we had a lot of good stuff to cover. First off, quick on the media, I'd like to thank Althea Thompson and Joseph Cole over at Cheddar for having me on Monday to discuss Starbucks earnings preview, and we went into a lot of details about the expected margin contraction and the attempts for unionization, which we'll cover a little bit in today's call. But by and large, it came in as expected in terms of the margin contraction. They had to pay a bit more in wages because of the COVID. They double paid people. They paid people to stay home who had COVID, and then they paid for the people to fill their positions. So that was a short-term thing. The stock held up very nicely. I think a lot of the bad news was priced in. As far as the unions go, right now they've got 2 stores unionized out of 9,000 or so in the U.S., and 1.2% or so of food service is workers at food and drinking outlets were members of unions. That's far below the private sector at 6.3%, and that speaks to the reasons we discussed last week in one of the Ask Me Anything questions, is that unions work best for areas where it takes a long time to develop a skill, whether it's acting or pipe fitting, construction, HVAC, those type of things, where plumbing, there's long apprenticeships, teaching, etc. Whereas in the food service industry, the turnover is so high, it's tough to get traction and organize. Plus, they have to negotiate on a store-by-store basis. And plus, it takes on average 409 days for unions to ratify their first contract. So I don't think that's as much of a headwind as people were worried about. The big headwind was China being down 14% year on year due to their zero COVID policy, which also probably won't be lasting for a whole lot longer. Maybe as they get through Omicron in another 3 months and the Olympics, etc. But that's also going to be a temporary situation, and then those international comp store sales are really going to accelerate, and they're even when you look at their international expansion, they're opening 2,000 stores next year. 75% are going to be in outside of the United States. Why is that? Well, at the store level, operating expenses as a percentage of revenue were 50% in the United States. They give them healthcare if they work over 20 hours. They can get free college through Arizona State University online if they get accepted to the college. Tremendous amount of benefits. So there's, the idea of unionizing, it's like biting the hand that feeds them. I mean, they have one of the most generous benefit and compensation packages. To unionize against that, I think is trouble. I think the labor market is such that you can just ask for more money and you'll get it, or you can go elsewhere where your value to the marketplace is recognized at a very easy clip. So went into a lot of those factors on the clip. Well worth watching if you're interested in Starbucks. I want to thank Bansari Kamdar for including me in her Reuters article. This was 2 days ago. And market was down in the morning. I said the market just wants to digest ahead of big earnings. Alphabet and Meta are going to be critical for the health of the market this week, says Thomas Hayes. And that's certainly been true. Alphabet earnings were fantastic. Plus, they're doing the 20-for-1 split. Facebook, on the other hand, were a disaster. And that's why the market's down today. It's interesting. Facebook really complained about cost inflation and supply chain disruptions impacting their advertiser budgets. But when you talk to the folks over at Google, they had absolutely zero problems. Their search revenue was off the charts and their advertising revenue was off the charts. YouTube was a bit light, but it's still bigger than Netflix. So tale of two cities. And I think that this bet that Facebook or Meta is taking on the metaverse is going to be, do or die. And the other problem is it, because of the amount of spend, I think, let's see, I think it was something like, so the family of apps segment, which includes Facebook, Instagram, Messenger, and WhatsApp, reported operating income of $15.9 billion. But the metaverse ate away $3.3 billion of that. So that's why they had, I think it was $10.9 billion or something like that in operating income. The metaverse had an operating loss of $3.3 billion. They reported net income of $10.29 billion. So $3.3 billion less due to metaverse. So they better be right on that. And the other problem is their revenue growth could be as low as 3%, between 3 and 11% in the coming quarter. The guidance just crushed the stock, whereas the last year, Facebook's revenue was up 48%. So certainly, obviously, tough comps, but at the same time, if you're going to have a premium multiple, you have to have premium growth levels. And with the bets they're making on Meta, it's questionable whether, how cheap does this stock have to get before value investors can step in, because it's on the basis of what this is looking like. They're no longer a growth story. They're a phenomenal business. They're a go-to place. The other thing is obviously the Apple changes in the iOS, which has made tracking users more difficult. That's going to impair. They are developing a workaround that will get them better tracking somehow, but that's going to take some time. And so I think that the stock is going to, it's turned into a show me stock. It's going to be in the penalty box for a while. Would I look at it in the 220s? I think it's in the 240s right now. I might start to look at it. Let's see what happens in the next couple of days. But you're really making a bet with incomplete information, so it certainly wouldn't be anything high conviction. And I might be more inclined to just let's see how it plays out over the coming weeks and see how the street starts to interpret it. They also complained about TikTok, taking share and growing much faster, etc. On the one hand, this stuff all looks bad. On the other hand, they've been successful in taking the attention off of them about the reported bad things that Facebook does to users and et cetera, and the crackdown from the government. So, this is as good a time as any to have changed their name, changed their focus. It's like a magician creating a new illusion, and kitchen sinking the quarter with all these expenses from Meta to make it look like, well, we're not a monopoly. Our businesses are eroding. TikTok's stealing our share. We're not making any money on Meta. Leave us alone. And I think that's a clever strategy. So on the one hand, it could just be a kitchen sink type of scenario while the attention is on them. On the other hand, their businesses could be eroding. They had negative user growth, modest negative user growth. Keep in mind, they have 1.93 billion daily active users and 2.91 billion monthly active users. So at some point, the law of large numbers had to kick in. And then also people are obviously shifting from doing digital stuff to doing real life stuff with the whole pandemic. So that could effectively toggle back and forth. So it's interesting, but I think it's not interesting yet. And it goes to show that, this is going to be an environment for stock pickers when you can have a Google do so exceptionally well and a Facebook do so terribly and surprise to the downside. Amazon will be a good look tonight. That's more of a stable business. My guess is that'll be more of a Starbucks story where labor costs were too high and the market will be a little upset about that. But like Starbucks, they'll raise the price of coffee. They'll raise the price of Prime. And I think it's largely short term and paying people while they're out, while they have COVID, and then double paying for the same shifts. Certainly Omicron has had that type of impact and probably will in Q1. but should be able to be a look through. So that's that. Let's move on to the questions of the week. Okay, Ben, first name only. Quick thoughts on buying Boeing and Intel at Friday's levels, please. I don't know about Friday's levels. Let's take a look. I love Intel here. I think this works to, up to 85, 90 over the next three or so years, 75 in the next couple of years. So yeah, I think their plan is going according to plan. Boeing, still love here. It's doing nothing. We haven't got the catalyst from them taking off in China. That was promised before the end of the month, but that should be in coming weeks. So, it's done nothing in a year waiting for this catalyst. Let's get the catalyst and see how it acts. And I think this is a home run long-term, operating in a duopoly and a good thing. Ben, first name only. And Tesla, too, please, buying at Friday's levels. I don't know what this means about Friday's levels and this and that. I mean, you either like the business and you want to own it, or you don't. But for me, there's another question on Tesla, so I'm going to defer that until that question. I'll answer Tesla all at once. But as far as Boeing and Intel, I love them here. I'd be adding, no question about it. Dr. Matt in North Carolina. First, thanks for your revolutionary podcast, bringing sound investment principles to retail investors. Hooked on it and look forward every week. Thank you for that. Wondering, can you speak to the retail investors' potential use of leverage through options and margin, e.g. in an approved TD Ameritrade account, for example, buying call options for BABA where confidence is high? What do you think of buying in-the-money strikes 100 to 110 with the delta of 0.7 by varied expirations, perhaps 3 to 18 months out, since hard to predict when that fish will stop fighting and get in the gosh darn boat? That's, great. Obviously listened last week. Can you compare the strategy with buying the stock itself on margin, knowing the margin rate is 9%? Obviously, using leverage has greater risk with greater potential reward than simply buying the stock alone. So when confidence is high, is it the time to use leverage for a segment of the retail investor's portfolio? Maybe an analogy is renting some extra poles or chartering an extra boat captain to fish more aggressively in the right spot. Thanks. Great question, Doc. I think you're spot on here. I do like your idea here of the in-the-money strikes and, layering 3 to 18 months out. I think that's also, you could probably go even 24 months out. So I think that makes sense. Margin rate shouldn't be 9%. I'd just switch over to Interactive Brokers. It's much, much less. I'm not a big fan of buying stocks on margin. So how I would think about doing it is maybe put 90% of what you're going to allocate to that position in stock and 10% in long-dated options. So, if you've got, let's say you've got, 18 months out or something like that, 110 or 120, and you've got 10% of your allocation to that. So those could wind up, being 5 or 10 baggers at least on 10% of your portfolio, 10% of that position, and then the stock itself, a double plus, and you're going to do just fine. So I wouldn't go all in on just options per se, or all in just on stock, but there's a way to kind of get the best of both worlds. You still own the stock, so you have time, because as this works, the stock is going to be a lot higher than it is today. So even if you run out, if you allocated 10% of that position to options, even if you run out of time on the options, you still got the stock that's going to more than pay for it over time. If you have higher conviction, maybe you go for 20% options and 80% stock. That type of thing is a good way to balance it. And then you want to balance it as a reasonable portion of your overall portfolio and manage risk that way. So I hope that helps, but I think you're spot on in how you're thinking about the options further out in the money is good. 10 to 20% of whatever that position is going to be, whether it's 5% or 10%. Again, this is opinion, not advice. You could also do long dated out of the money call spreads, where you can find a $10 spread 2 years out. That's, for $2, something like that. And if you're right, you make 5x on that portion of it. So you could put 2% of your position in that, 8% in the monies, and then 90% in stock or some combination, or 4%, 16%, and 80% stock, and get a little more juice that way. But I think how you're thinking about it, it doesn't have to be all one thing. It doesn't have to be all one expiration date. It doesn't have to be all one strike. You can do a blend, and it's a way to get a little extra alpha. And if you blow out your options completely, you still got 80 or 90% of stock that over time should double or even triple from these levels. And you'll be good to go. And if it happens sooner, which we think it will, then you can really get some extra juice on that. So great question from Dr. Matt in North Carolina. Okay, Mark Messer. Tom, ask me anything question for the podcast. Do you own any Tesla, even in your personal account? You mentioned you read Elon's book and said to never bet against him. Would love your thoughts on this. Thanks for all you do. Just because I would never bet against him doesn't mean I would bet for him. So here's the Tesla stock. I mean, the bottom line is it's come in a little bit. I love how the business is growing. Like if you look at the top line over the last 10 years, how it's just consistently grown. You now look at the bottom line, earnings is starting to grow, positive earnings, positive cash flow. The problem is, you're paying, you're paying like 90 times next year's earnings, albeit if they continue to grow at the same pace, it's a lower and lower multiple a few years out, but they'd have to triple to pay a 30 times multiple. And I think with competition coming in, I mean, look, I got to say, like the Tesla is a nice car and all of that. And many of my friends have them and they love them and they're great. But they've got to update it. And it just seems like they're struggling so much to, meet the current demand and the chip supply. And they've had the same body style for, forever. And the bottom line is Americans like big cars. And bottom line, they like big cars and they like good looking cars. And they're kind of SUV with the gull wings, the X or whatever it is. It's kind of, it's cool, but it's not that cool. I think that silver truck that's coming out, I think that's going to be really cool if they can ever get it out, but it got delayed another year. But I also think that's going to be a niche market. Like, would I buy one of those for fun? Maybe. But if they made something that looked like a really cool SUV like Rivian is doing, I think, if they'd done that now or in a year, they could get all of the market because, Americans love big SUVs. They could get the whole market before they got to deal with Ford and GM and this. And they're giving Ford and GM this open door to get out ahead of them on the pickup trucks. They got the Silverado. They've got the F-150, which I think are going to be huge sellers. Ford put out that Mustang. That's pretty cool. The smaller SUV. So, they've done incredibly well in an environment where there's been no competition. The question is, how will they do where there's really competition? In other words, they've got to really up their innovation and literally give customers what they want. And what Americans want is big trucks and big SUVs. Like, that's never going to change. It's in our DNA. And if you do a reasonable looking big truck or big SUV, quickly before Ford and GM start working their way into that market, they'll crush it, and it's probably cheap at 90 times earnings or whatever it's trading at today. But for me, certainly would never bet against them. But this for me is too rich. It's a lot of the positives that are to come are already priced in. If the business is 2 times what it is today, the stock is, probably still fully valued. So, doesn't mean it can't go higher. It doesn't mean it's not going to trade up to new highs in the next few months. It's just, It's like, look, it's like all these other stocks. Peloton fell from whatever 100 times sales to 80 times sales. Was that the bottom? No. Was 40 times sales the bottom? No. Was 30 times sales the bottom? No. Was 20 times sales the bottom? No. So I think you just have to, I think for me that goes into too hard box. Great company, great leader. Price is what you pay, value is what you get. I just don't see the value there at these prices. But I can see, technically what you all are probably looking at. This thing's going to bounce up. Yeah, maybe it will. I could care less. I'm not going to participate. Okay. Jordan H. in the UK, long-time listener, second-time question asker. I hope you are well and want to start by saying thank you for the podcast. Your opinion, not advice. That's correct. Go to hedgefundtips.com, click on terms. This is opinion, not advice. I don't know what your financial situations are. I'm just sharing what I would do based on the questions that you're asking personally, but my situation is a lot different than yours. Talk to your financial advisor before doing anything. I have 2 quick questions for your next podcast. How does BTEK, iShares NASDAQ US Biotech ETF compare with your own biotech additions in recent weeks? Do you think this is an adequate pick for a British investor? I think that one mirrors the IBB. That's perfectly fine. And number 2, we've had the 10% dip in the S&P in early 2022, exactly underline, bold as you predicted. Thank you very much. How many more do you think we could potentially see this year, and what methods do you use to gauge when they might occur? I've spent a lot of time studying the history of the market, like literally years of my life. If you name a year, I can basically tell you off the top of my head exactly like how many corrections there were, what were the magnitudes, in many cases, what were the catalysts. So I've seen a lot. That doesn't mean that history repeats. It does mean that it does rhyme. And coming off a very low volatility, high performance year, you often move into, for the indices, you often move into high volatility, low performance years. And I think that's exactly what we're in terms of the general indices, which I covered a little bit in this article of the week. My best suggestion is, my guess is we're going to get 1 or 2 more of these type of hair raiser type of corrections. The 8 to 10% plus variety on the S&P, and there'll just be opportunities to participate. But we're not really interested in what's happening in the indices. We're looking for dislocation in particular stocks, in particular sectors, and we want to jump on that largely irrespective of what's happening in the general indices. Okay, Ben first name only again. Tom, what are your thoughts on Northrop Grumman? Also, does pre and post market 4 to 9:30 a.m. and 4 to 8 p.m. stock and ETF activity trigger stops? Okay, Northrop Grumman, I love. I'd buy on the pullback here. Personally, I think this thing is going to work a lot higher over the next 2 years. Same with Lockheed, same with Boeing, same with the whole group. It only triggers stops if you have your stops set to include after hours. And it's a good way to get your stops hit because the volume's light and they can take it against you, take you out of the stock, and then it runs up on the open. So I'm not a big fan of stops. I don't invest in anything unless I would buy the business entirely for the most part. So that's that. Good question. Okay. Ishan Zakaria Kawaja, thank you for another great video, Mr. Hayes. At the moment, I am exposed to biotech sector through ETF IBB. I was wondering what your thoughts were on the 3 times bull biotech Labu. Look, more volatility, more upside. We have some exposure there. You've got basically 3 choices if you just want to get a basket of the stocks without having to bet on individual stocks in the group, which is a little tricky because you've got a bunch of pipelines. I'd rather bet on the aggregate of pipelines and the aggregate of pricing power and the aggregate of innovation rather than trying to discern, each, trying to get 4 or 5 stocks that will have catalysts. I'd rather just play the whole group for this particular sector, just because it's a lot different to analyze than other sectors. So yeah, it's just higher risk. So again, it all comes down to position sizing, and more or less any position we ever put on, we have to assume that if it went to zero, would we live another day? Whether that's options or stock, and do we have enough uncorrelated positions in the portfolio to make up for it over time? And the answer is yes. And then if you still like the thesis, then you can do it. I just say it's just going to be a lot more volatile, and there's some risk to leveraged ETFs, but it really depends on your risk propensity and your understanding of what you're investing in. If you've done some work on the sector and you have confidence and you can withstand, if you buy Labu at $20 and it goes to $10, are you going to get out and puke it before it goes back up to $50, $60, $70? If so, then do not do that. Just do XBI or IBB, because these things, they whip around and they'll take your head off if you don't understand the volatility that you should expect. Okay, Paul Cincinello. I own Boeing on your recommendation and continue purchasing as it declines. 223, 206, 194. Just transferred a few $100K to buy more for the long-term hold. Does Boeing have any risk of another competitor besides Airbus? Can the Chinese manufacture airplanes? Thanks for all you advise or opinion. Paul Cincinello. Paul, I'm buying right alongside you. I think since you wrote that 193 was last week, I think it's up to 208 this week. So the answer is yes. We continue to add opportunistically as we can. There are some catalysts on the time horizon, but over the long term, it's a duopoly. Are the Chinese trying to manufacture their own planes and plane engines? Yes. Will they eventually? Yes. However, I don't think they're going to be the same quality as GE and Boeing, if and when they can ever actually get them off the ground, pun intended. So I would say that if a duopoly turned into an oligopoly, the demand is still going to be extraordinary for the next 10 years, and there's a beachhead. So that's something certainly that could be in the back of your mind, but not something that's imminent. It's like buying a bank and people saying, well, DeFi is going to take away all the banks. Okay, but it's not going to happen right away, and if it ever happens, and more likely than not, it doesn't. Okay, Warren Buffett quote of the day: most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. And I think a lot of newer investors found that out for the first time last year, with many of the innovation type stocks that have now been cut in half, and if not 75 or 80%. And out of the ashes, the phoenix will arise. There will be a handful of those hundreds of stocks that are now down, 70, 80%, that go on to be great businesses 10 years from now, but it's going to be a long slog. So we've always focused on getting interested when no one else is, and that's why our 2 largest positions are for this year are now Biotech has been fully placed in the last week and a half or so, and China Tech, which is Alibaba, and we think that's going to be great over time. So a couple quick things about the market. This was from Fundstrat Tom Lee. Buckle up, violent upside for the S&P lays ahead. New highs, sentiment is so bad it's good. And I covered a little bit of this on the Claimant Countdown last week before this note was published. But it shows that when the AAII sentiment survey, which we cover every week, the bulls minus bears hits these levels, which it hit 21. The bullish percent hit 21% last week. If you remember in my note, I said this is an extreme, usually near inflection points. The S&P is up 6.5% in the last 5 days. I think it gave back, 1 or 1.5% today on the Facebook, but that's to be expected. You know, when you move up that big off of pessimism, everyone was buying in the last day or 2 days, so you got to, you know, take them out to the woodshed, shake them out of their stocks, and then we can push higher again after the late money got flushed out again, so they can chase higher again. It's just the way the market works. I have no idea, but it's just years of observation. So looking 1 month out, the average is 8.4%. 3 months out, the average is 13.8%. 6 months, 19%. I wouldn't bet on that this year. And 12-month, 32%. I wouldn't bet on that this year, but I think it's reasonable that. Well, actually, come to think of it, because you're talking about 19% off the lows, which the S&P off the intraday lows was down 12%. I think closing lows was below 10%. So yeah, I mean, if you're up 19% before year end, you're probably up high single digits, low double digits. So that's perfectly reasonable off of that level of sentiment. I like this tweet from Tiho Birkin today. Interesting developments in the market this week. This was late morning today. Alibaba's up 7.6% on the week. Tencent's up 4.7%. Facebook is down 19% and PayPal's down 22%. So it shows the divergence between the high multiple US tech and now the low multiple China tech with faster growth. The shift is coming. Money is starting to flow to where there's actual value versus just price. And that's really nice to see in such a heavy market with Facebook from last night. Okay, the January barometer. Here's Ryan Dietrich. Good news is the January barometer has been broken lately. It used to say, as goes January, so goes the year. In fact, but that's not been the case. In 9 of the past 10 times, stocks were down in January. The final 11 months were higher, some by a lot, like last year. Be aware of this little fact when you hear the narratives over the next few days, people talking about the January barometer. On average, 11 months out, the market's up 13.1%. So that's good to see since 2009. The GOAT retired this year, greatest of all time. I remember we were down in Tampa last year for a swim meet. We're driving out of the airport to the hotel, and I'm thinking, and I'm looking, I'm like, we're going to be literally watching the Super Bowl from 5 minutes away from the stadium from a little TV. This is absolutely crazy. This could be Tom Brady's last Super Bowl. We're going. We got the tickets last minute, and I thought it might be historic if it was his last ever, and it turned out to be. We had a wonderful time, and just so lucky and grateful to have experienced that, to see him get his last ring as a player. He might wind up with a few more as a coach or an owner. We'll see. Okay, moving on. Value stocks just had their best month since the peak of the 2001 dot-com bubble, and there's still more upside, says Bank of America. And what they show here is a table, annual relative growth versus value total returns for Russell large cap. So you can see this period here from 2014 to 2020, where growth just had this aberrational outperformance relative to value, whereas 2001 to 2007, this is when value outperformed, and historically, and then you see, 98 and 99 where growth outperformed for a couple of years. But on balance, if you add all these up, value is generally outperformed over time. Now, that is interesting, but there was another note out here. Value stocks are outperforming growth, but not likely not for much longer. Here's why. And, some of these tech stocks have gotten beaten down so much that it's kind of interesting. So what they're saying in this article here is, in aggregate, analysts expect earnings per share for the value fund. Okay, so they're looking at the value index, S&P 500 value index, VOOV, versus the S&P 500 growth index, VOOG. They're expecting earnings per share in the value fund to grow 10.5% for calendar year 2022, which is better than the growth index is supposed to grow 7%. So it's natural that value would outperform, but they've clocked a lot of that outperformance already in January. So, which is why we lightened up on some energy and some banks to put it into sectors that we think can rise a lot more in a much shorter period of time, like biotech and like others. So the bet is not that energy and banks stop going up. The bet is that things like biotech go up a lot more and a lot more quickly, versus hanging around for another 5 or 10% for 12 months in energy and certain banks and that type of thing. Although we kept some of each of those, it's much smaller than it was a week or a week and a half ago. Okay, the other point that they make here is that value looks less and less like a coiled spring at this point. For now, we still favor value, but continue to stress this as a tactical opportunity as rotation risk back toward more growth-oriented laggards increases on the heels of the valuation set. So they talk about basically the correction in January, which was meaningful. I mean, it was down 18% intraday for the NASDAQ last Monday. And then the Citigroup strategist noted on Tuesday evening, our tactically positive strategy views on value as the trade becomes increasingly consensus. So they're starting to acknowledge, like, hey, this is super crowded. Like we covered with the Bank of America Global Fund Manager survey the last 2 weeks, like, the overweight to tech was the lowest since December 2008. And the overweight to commodities was at historic highs. I don't want to be in that crowded of a boat on either side. So then the play becomes, okay, where is there actual value in tech and or growth? And we found that biotech looked the most interesting in that context. There are some tech stocks like Value Tech and Intels of the world and that type of stuff, and some others. But the key is you want to... So from being a pound the table value only, and now it's done the outperformance last year. Banks and energy were in the top 3 performers for the whole year. And the first month this year, it was like a record month of all time. It's at that level of euphoria when everyone's kind of picking up nickels in front of steamrollers that we want to help them out and move on to where there are more fish and less boats. So, okay, this is from Kristen Flanagan over at Bloomberg. I love this one. Flight from risk drives biotech stocks to worst start since 2016. Worst start to a year since pricing politics of 2016 election. Interest rate worries adding to other industry headwinds. So, yeah, what we're going to see here, I just want to pull this up. I did the XBI ETF top 30 holdings this week. We had done the IBB a couple of weeks ago, and the conclusion was similar. I think the IBB, the IBB earnings power was flat. It was revised up. So the top 30 weights of the IBB cumulative earnings power was revised up by 14 thousandths of a percent. So it was basically flat in 60 days while the ETF got crushed. The XBI equal weight was very similar. The cumulative earnings power was revised down by 0.4% of a percent, 0.4%. But during this time frame, here's the ETF that represents those 30 top holdings, was down 37.3%. So that kind of dislocation when earnings power is basically the same and the ETF's down 37%, that gets really, really interesting, and that's why it's now a huge exposure overweight for us. One of our largest positions with Alibaba. So that's that. So what Kristen is saying in this article, okay, valuations have now fallen so much. There are about 100 biotech companies whose cash stockpiles exceed their stock market values. So if you were to liquidate them, you would get, you'd get a lot more because you'd get the IP and you'd get any of the assets. But just the cash on their balance sheet is more than the price that they're trading at in the stock market. That's a margin of safety. So So that's according to Truist, indicating that investors are deeply discounting the outlook for growth. You think? So they've given no credit to the intellectual property, no credit to the ongoing sales of their drugs, no credit to their pipeline, no credit to their buildings or assets, no credit to their people, no credit to their R&D, no credit to their patents. They're trading below cash. I mean, that is rare. So it's not just the smaller biotech companies with no drugs yet on the market. COVID vaccine makers have joined the rout. Moderna Inc.'s 37% January drop is the steepest ever and has turned it into the worst performer in the S&P 500. BioNTech is facing a similar drop, while peers working on second-generation shots like Novavax and CureVac have been virtually sheared in half. I wouldn't be overweight on vaccine makers. And fortunately, they're not overweight in any of these ETFs or indices, because that's kind of a yesterday story. I mean, it's like, we've got a new vaccine. Like, the existing one is kind of good enough. I mean, it's like, at this point, you got a pill that cures it, like Pfizer. I'm all ears. But, vaccines at this point, the people who have gotten vaccinated will keep getting vaccinated. The people who haven't are just never going to have it. And with the vaccine mandate struck down by the different courts, even Starbucks, which is the most, quote unquote progressive company out there, they've done away with their vaccine mandate for workers because, you limit 20% of the population, which means you got to pay that much more to get someone to show up. And it's just uneconomic, and they have owners to answer to. So the vaccine trade is over. I agree with that, but the vaccine trade is a very small proportion of these indices and these ETFs. Large cap makers of drug devices, scientific tools, and tests have slumped too. We think there's some value in the device makers. And strategists have pointed to hedge funds as one culprit, with some forced to liquidate their holdings as disappointed investors pull out of cash. Yeah, there were a lot of hedge funds. There were articles like these tech-heavy growth funds. Some of them have quite a few of them have blown up in January. So that there's a lot of forced liquidation still going on in the market, particularly in tech and I guess in biotech as well. Still, there may be signs that the biotech downturn is reaching its nadir. The equal-weighted S&P biotech ETF, which trades under the ticker XBI, plunged 50% over the 7 months during the Clinton-fueled rout before its next advance. It has experienced a similar-sized drop over the past year, suggesting it could be primed for a reversal. This is a great chart here. It shows the last time biotech fell this much in this short period of time, and the same thing happened here. So that one was 49% as of the writing of this. It was 48%, I think, January 30th. So the low was probably in at that point, and it started to work its way higher in the last handful of days. And that's that. So I thought that was a pretty cool article. You often don't see that before you get a real rebound off the bottom. You don't see the headlines starting to come, but Kristen Flanagan is ahead of the curve on that one. And in spite of all the worries about drug prices, drug makers raised prices by 6.6% on average early this year. We went into that. Oil. Okay, 4 ways the Iranian nuclear talks could upend oil markets. So the worst case scenario would be a comprehensive deal. This probably doesn't happen tomorrow, but it is in the works. And the administration's getting desperate because it's very hard to get elected with inflation. Consumer confidence and inflation is joined at the hip. The more inflation there is, the lower the consumer confidence, and the numbers have been anemic in recent reads. So a new pact that's similar to the 2015 agreement, which I don't think it'll be that dramatic, which the U.S. pulled out of in 2018, could be the most bearish outcome for oil traders. Tehran could sell some roughly 80 to 90 million barrels it holds in storage, many of them located in its main market of Asia. It would increase production at oil fields at the same point. Output might climb from around 2.5 million barrels a day, mostly consumed by local businesses, to 3.8 million within 6 months, according to the IEA. And that's that. So, and then a partial deal is less impact. But that's why we lightened up a little bit on energy. We do like energy again over the next 3, 4, 5 years. But at this stage, we think that there will be an opportunity to buy back in. I think at some point this year, we're going to get a real pullback in energy, and we can reload on some of those. We still have some core positions, but we raised money to make room for biotech, which we've really leaned into. So, and it's been an unbelievable run since 2000 for both energy and banks. So, bulls make money, bears make money, pigs get slaughtered. So we didn't want to be a pig. OPEC Plus agrees on March output rise amid oil price rally, defying pressure from U.S. and India. It's interesting, when the last administration used to call up the Saudis and say, knock it off, we need you to do this, we need you to do that. OPEC listened. With this administration, they're just kind of like laughing at us and doing whatever they want, and that's what they've done. I think there is some real hesitation because obviously oil went negative, so they have memories of that. They don't want to ramp up too quickly, but it's just a different relationship altogether, and that's OPEC. Okay, the energy sector surged nearly 19% in January as we were lightening up out of it on that strength. Here's what history says about returns following the only other 5 months it's risen at least 15%. So it shows in this table what happens the last 5 times it rose 15% in a month. In 2005, it was down. 1 month later, the sector was down 3.6%. 2 months later, 8.8%. 3 months later, 7.7%. And then even in the others where it was positive, it was really weak, with the exception of November 30th, 2020. But that was a rare situation because it was coming off of negative prices. So naturally, if you're crashing, 80 some odd percent, and, small rise is like big numbers. So if you take out 2020, you're going to find that these are really anemic returns, and this really skews it. I mean, 5% 3 months out. Even so, let's just assume we keep that 2020 in. 5.6% 3 months out is not that attractive. We want to be in other things that can move very fast, much faster, and generate much bigger returns. In other words, we don't want to stick around to pick up the last few pennies in front of the steamroller. So there's a high probability it could be negative, but even if it plows up, it's going to do so at a much slower pace because we participated when the gains were the biggest in the shortest amount of time, and we'll leave the last few pennies for someone else. So in the short term. And then if we get a hard pullback, we'll probably reload for another run. Qatar seals Boeing freighter deal with surprise 737 order. So they're getting the orders. They have that new plane, the 777X for freighters, and they ordered 34 of them. They threw in another of the 25 of the 737 MAX, which no one expected. The demand is going to be off the charts. It's just the short-term catalyst is getting off the ground in China, which hopefully is any day. It should have been 3 days ago. So when that happens and the orders start flowing in, people will get interested in Boeing again, and I think it could go 270, 300 pretty quickly. China and Japan are Citi's top picks for Asia markets, so sentiment is changing. More and more people are looking at emerging markets and China on relative valuations. And I think the heat is on for Xi Jinping going into the National Congress, which we've talked about many times. Legendary investor George Soros put out a note, says China's real estate crisis is a major threat to Xi Jinping's grip on power. And you don't want to have a loose grip on power going into that transition meeting. So that is forcing their hand to put the foot on the gas and to ease up on the regulations in tech. Also, you're starting to see some dissent. This is from the FT. Chinese documentary prompts rare criticism of Xi's corruption crackdown. And then the third article from the Wall Street Journal, to achieve common prosperity, Xi Jinping seeks to scale China's 3 big mountains. So what does that mean? He's cracking down on 3 things. He wants to make education less expensive. He certainly did that last summer by shutting down the whole industry. But the kids won't be as smart because they won't have the education that they were getting from the tutors, but that's fine. Healthcare, he wants to bring those costs down. We have no real exposure with Alibaba. And housing, he wants to bring that down. We don't have any exposure. So I like that the focus has changed to these three things that are causing people to not to want to have kids. And now they realize that in order for them to grow and to have a strong year into the National Congress, they need tech. And they seem to have kind of, eased up on the crackdown is in the rearview mirror. Emerging markets took a beating last year. Now they could be the smart play institutional investor. This is just another relative valuation argument. They're trading at their 5-year low PEs. China's the biggest weight. We agree. And Charlie Munger, it's waiting that helps you as an investor. A lot of people just can't stand to wait. That's why I'm not interested in, questions about stop losses after hours and how does it look at these levels. I mean, do you want to own the business or don't you want to own the business? Would you have to own the business? Would you be willing to own the business forever? How do the future growth prospects look? Do you look at some short-term technical indicators? Yeah, you want to get the better price if you can get the better price, but, understand value. Now, price is less important than value over the long term. I mean, Tesla has value, just not at this price in my world. It could certainly double and triple from here, but I think there are some other, headwinds and then the valuation becomes an issue, etc. UPS had great earnings, which shows some nice health in the economy. Alphabet crushed it, and Meta, SHIT the bed. Joe Manchin gave a fresh hint on what he wants from a skinny Build Back Better program. Just fix the tax code. So he wants corporate and individual taxes to go up. The problem is Kristen Sinema over in Arizona gets it, and she understands the Republicans in her state, which has become a purplish state, and she's objecting to raising any corporate or individual tax rates. So the idea of getting these mini bills through is looking less and less as time ticks away. And I don't think the inflation numbers are going to come down quick enough for them to have the time to do these mini bills. The last thing they want to do is pass a big spending bill with inflation expectations where they are in a fragile type of environment, with the Fed having to make major decisions. So I think the probability of anything major happening this year is slim. That's on account of two independent thinkers in our Senate, which we could use quite a few more independent thinkers moving forward. Wages will be the key in January's Omicron hit jobs report. Here's what to watch. I think bad news is going to be good news tomorrow. We saw the ADP report was weak. I think Omicron certainly had an impact in January. And the report will probably come in weak again. We had a weak one last month, and that's probably good news because it'll make the Fed think twice about how quickly they want to go, the speed and magnitude of what they want to do in tightening. So I think tomorrow morning's bad news will be good news in that it kind of puts the Fed on their heels to not be overly eager to be aggressively tightening into slowing growth and jobs and the dual mandate, full employment and stable prices, etc. So that's what to expect. I'll be on CGTN America tomorrow night between 7 and 8 p.m. talking about the jobs report if you're interested. And the article of the week. So what happens next? Last Tuesday on the Clayman Countdown, I laid out 3 key reasons. I believe the worst of the January correction was in the rearview mirror in the near term. This was the exact point at which I was on. Liz was like, "Are you sure about that?" And I talked to the VIX being elevated at 38. The put call was at 126, and the AAII sentiment, which we covered earlier in this call, being at an extreme that was usually around inflection. So while it looks obvious now, it was not an easy call to make in real time. The sector we mentioned we were leaning into is biotech. We've covered that already today, so we can skip right through that. Expensive coffee is still cool. We covered that. The Cheddar interview, you can actually click on that if you're interested in Starbucks. There's a lot of good information packed into that interview. That was great. Thanks to Allie Thompson. And then half glass full with the unfettered 6.6% S&P rebounded in the past week, it would be entirely predictable to have some short-term digestion of an aggressive move off the lows. We wrote this last night. We were getting that consolidation today. Writing this on Wednesday night after Facebook just missed on the bottom line and issued weak guidance. It may be just the catalyst to scare some out of their recently purchased positions in the next day or two. Looking at the top holdings of the S&P 500, Meta is a top 10, but they're only 1.97%. So we'll see how Amazon does tonight. What's Amazon's weight? Amazon's a much bigger weighting, 3.38%, both how it reports and then how it responds after the call. And then overall, however, we think the markets can work higher ahead of the March Fed meeting. The jobs report may come in weak on Friday. We saw indications of that in the ADP report, leading market participants to reevaluate how hawkish the Fed will be given the short-term impact of the virus. In other words, bad news jobs will be good news. Fed slows tightening pace or balance sheet runoff pace. We saw the same consumer weakness with Delta this past fall. Spoiler alert, they will recover. The consumer loves to spend money. They just don't like to go out and get sick. So this is what happened with Delta on lodging, travel, and other entertainment. The same thing's happening with Omicron, and it's likely we're going to see the exact same type of rebound in coming months, particularly moving into nicer weather in the Northeast as well. It will be helpful in accelerating that. Short-term indicators are also signaling that any heavy trading in Facebook impacting the overall market indices should be contained to a few sessions. So we got our first one today, but if you look at this, PMO by all, it's down at the 0 level. Just trace it back. This is usually where you want to be a buyer, not a seller. Buyer, not a seller on the PMO by SPX. On the bullish percent SPX, these are levels you want to be buyer, not seller. And the VIX is still rolling over. Probably spiked up a bit today, but that's just how it works its way down. Two key driving factors are still present in the market. Earnings continue to hold up, although estimates are not improving as quickly as we would like to see. They're still at 223.94 for this year. Liquidity is still abundant. Taper will run through March. In the meantime, they're still adding liquidity. They're adding to the balance sheet through the end of March. That will change, but it hasn't changed yet. Here's the balance sheet. And on to the shorter term general market, the AAII sentiment is still, there's still a lot of fear in the market at 26.5% bullish and 43.7% bearish. It's come a little off the boil from last week, but again, nowhere near any type of confidence or euphoria. That's where you want to be. These are the kind of environments where you want to be more looking what to add versus what to get out of. CNN Fear and Greed Index, same thing, still at 36. It's probably lower today. And then the National Association of Active Investment Managers got down to 53%. So any strength that comes back after these few chop sessions, they'll have to chase back up. So I think Fundstrat's thing about violent to the upside and possibly new highs is not unrealistic. He's always bullish, of course, but I think there's something to be said for that. So as we said multiple times in our weekly podcast VideoCast late last year and early this year, 2020 would be much different than 2021. We'd have higher volatility, 3 to 5% pullbacks to 2021 would become 8 to 10% plus corrections in 2022, and lower returns, high single digit to low double digits in 2022. So far, that has held to be true. With the excess crowding into indexing in the past decade, there has to be a time when the, quote, crowded trade punishes its adherents. I think 2022 sets up well to be that time. General indexers will find 2022 very unsatisfying as they grind sideways with increasing volatility for nothing more than average returns at the end of the year. Opportunistic stock pickers that can pick stocks and sectors in distress and be patient will be amply rewarded and may see some of the highest returns of their career. Time will tell. So that's that. A couple quick things. Earnings on balance have been good. Obviously, Facebook was a bad surprise, but there were more good surprises than bad surprises. Alphabet, Exxon, etc. Quite a few others throughout the week. And then economic data. Chicago PMI on Monday, better than expected. Manufacturing PMI was better than expected. ISM manufacturing PMI beat expectations, still in expansion at 57.6. So that's good. The JOLTS, there's still 10.9 million jobs out there. Crude oil inventory is still a draw of 1 million barrels versus 1.5 million build expectations. And then here's where we saw let's see, where were the ADP numbers? Okay, so they were negative 301,000 versus positive 207,000 expectations. That's part of the reason we think tomorrow is going to be miss expectations, which will be good for the market. Put the Fed on a leash. And then the continuing claims came in higher than expected. That's not good. Initial jobless claims were a little better than expected. So we'll see. We'll be back next week. Same time, same place. We got it in under an hour this week. Happy about that. Thanks for listening in. Make it a great one. Bye for now.